Good morning, everybody. I think that's 11 o'clock, so we'll kick off and make a start. Thank you once again for joining Angus, Aston and myself, Ian Parker. We're going to try and talk to you today about pensions and how they can be used throughout a lifetime. I'm sure many of you will already know us, but just as a little bit of background, Angus is a senior financial planner with Wise Investments. And I wondered if you just wanted to say a few words about Wise, Angus.
Certainly, yeah. Good morning, everybody. Well, a lot of it's on the slide there, but we've been based in Chipping Norton for 28 years since we were founded, and we'll stay there as long as we can. The main areas of advice that we give are in relation to investment and investment portfolios, pensions, taking pension benefits, along with planning for inheritance tax and succession and protection, as you can see there. We try and take a holistic, if you like, view of people's circumstances and finances, not just looking at one thing in isolation. So that sort of results in us having sort of fairly long-term relationships with our clients, which is just the way we like it. Are you going to tell us a bit about Whitley Stimpson?
I will do, Angus. Yeah, thank you for those few words. Just before I start, I've just seen a comment pop up in the chat that somebody can't hear us. Is that a universal problem, or is that an isolated thing? Before we go any further?
Well, I can certainly hear you.
Right. Okay, there's various other comments saying that people can hear, so that should be okay. So yeah, a little bit about Whitley Stimpson. We a long-established firm, originally just the one office in Banbury, but over the last 15 years have expanded far and wide across the Thames Valley, and now have offices in Whitney, Bicester and High Wycombe. As you can see there, we offer a huge range of services to our clients, right the way through from individuals needing tax returns to large corporates needing audits and advice. We pride ourselves on not just offering the compliance services, but also the advisory side, which differentiates us from a lot of other firms. And I think the reason that we gel so well with Wise is that our focus is as is theirs, the long-term relationship and really getting to know our clients and building that over many years. So I think that probably gives you a little insight into both of the firms. Just covering off the boring bits. This webinar is not designed to be advice and cannot be construed as such. This is really Angus and mine's own views on where pensions are at the moment, and clearly we don't know any specific circumstances. So if you're considering any of this, then you really do need to be taking advice on that separately. Just a little bit about today. As I've already said, this is a presentation about how pensions can be used throughout an individual's lifetime, and indeed how it can then be passed on. The intention is that it should take about 35-40 minutes for our sort of discussions, and then we hope to have time for a bit of a Q&A session at the end as well. The Q&A will be done through the Zoom question and answers function, which I think for most people can be found in the middle of the taskbar towards the bottom of the screen. I understand that for some people it might be in the top right hand corner, but hopefully you're able to locate that. If you've got any questions, please raise them in there, and we will do our best to answer them. I would just ask, if possible, if you could try and put a name with your question. We won't read the name out. It's just if we don't get to all of the questions, then we can at least try and come back to you separately. We did a similar webinar last week and had a few questions that were anonymous, and both Angus and I felt quite guilty that we hadn't been able to get back to everybody. So I think we were thinking that we would kick things off by talking about actually how young you can start a pension, start saving for a pension, possibly not you yourself, but maybe a family member saving for you, and actually take a look at the difference that this could make to your retirement income in many, many years' time. So at that stage, I think I will pass over to Angus.
Thanks, Ian, very much. Right, so, I mean, normally pension funds are things that are started by adults, aren't they? You know, when they join the workplace, it almost happens by default. And people don't really think about it too hard when they're in their early 20s. But I thought it'd be interesting to look at what if you started earlier, and the rules actually allow you to have contributions made for you from birth. So a child can own a pension fund. Normally they can't pay into it themselves, but their parents or grandparents, for example, certainly can. And everyone has an allowance up to the age of 75 of 3,600 a year gross for pension contributions, regardless of their earnings. So even if you have no earnings as a child, that amount can still be contributed for you. So the other aspect of it is that on a pension contribution, a personal contribution, you get immediate tax relief. And that means that for every £100 that's put in, there's a top up of £25. And if you want to make the full contribution, what it means is per year, you need to put in £2,880. And the tax relief is £720 goes on top of that, makes 3,600. So I thought it'd be interesting to look at a very basic and probably quite unlikely example. If some benign grandparents or parents decided that they'd start funding a pension for their newborn child. So we start over here, and with £100 a month, and that, as I say, gets grossed up as it is, as it's called, to £125 a month with the tax relief. And I've made an assumption that year in, year out, the investment, the fund, pension fund pot sort of grinds out a return of 4.5% a year. And now you can argue whether that's too high, too low, whatever. It's just an illustration. So on those assumptions, if this all keeps going with the parents and grandparents kindly contributing up to the age of 21, at that stage, the value would come to around 52,500. And supposing this enlightened 21-year-old thought, well, that's been great of them, I'll keep it going and I'll pay £100 a month as well, because that's what I can afford. And supposing they then leave that running and sort of forget about it until they get to roughly retirement age, 65 in this case, and with the wonderful benefits of long-term compounding of returns, the value of the fund is not far short of £600,000. Do the sums if you don't believe me. Just to sort of relate that to what's been contributed, the actual out-of-pocket cost has been £78,000. Not to say that doesn't include the tax relief.
Can I just interject at that point, Angus, very quickly, just to say that obviously in this scenario we're potentially looking at investing for a grandchild, and I'd just like to sort of add that, as you say, it's a fairly reasonable level of contributions to build a pot of nearly £600,000. But if you're in a position where you're saving for a pension for a grandchild, more often than not always the case, but it tends to be that you have some surplus income that you're using to do this.
Yeah.
Actually, we can link it in and plan from day one, so that it falls under the inheritance tax gifts out of surplus income rules.
Yeah.
Mean that those contributions for the grandparent are actually free of inheritance tax, and don't give them any inheritance tax headaches, either because they want to continue giving the £3,000 a year to their children, or whatever it might be. They can do this over and above and not have any concerns over that.
Yeah, absolutely, that's right. So it's quite neat from that angle as well. So this hardworking grandchild who's now 65 has this pension pot, and I've made an assumption that they then decide they want £25,000 a year of income from it, and that they live till the ripe old age of 90. I've ignored inflation because that tends to complicate matters, but it mustn't be forgotten about in the real world. And the way it turns out is that by the time they're 90, on the same growth rate a year, their fund value would be something like £626,000. So just slightly higher than when they retired. Now that, as we'll look at later, can go, if they die, it can go to a surviving spouse, or even to their own children, depending on the situation. So that, to me, is the benefit of starting young. It's worth looking, if you'll bear with me, at what happens if you don't do the first bit, and the child emerges into adulthood as a responsible pension saver, and decides that they want to start a pension at 21, and realizing they don't have anything at all in the pot, they start with twice the amount per month, 200 a month. With the tax relief, that's 250. The growth rate assumptions are the same, but they've started later. So on the same growth, they get to age 65, and the value of the pot at that age is, in this case, 416,000. So it's still a decent sum of money, but not as much as in the previous example, even though they've contributed more. So this is about the benefits of letting things stew for as long as possible. Again, same assumption about retirement and the length of time they live, but you get a rather different outcome in that when they get to 90, the value's more like 115,000 pounds. So that's still a nice sum to pass on to your spouse or your children, but it's worth noting if they live another 5 years, they'll have run out of money at 25,000 a year.
When you first showed me these slides, Angus, I'm not embarrassed to say that I actually almost doubted the calculations, because the values at age 65 didn't look they didn't look actually that dissimilar. I think 578 versus 416. On the face of it, I thought both are good sized pots, but clearly the value at age 90, one has continued to increase and one's significantly decreased. I think there's about £500,000 difference.
So, well, the reason for that is that on the assumed return, 4.5%, 4.5% of 586,000 on the previous slide is 26,400 a year. So it's just about good enough to support the 25,000 that's coming out, but on 416,000, the 4.5% is about 18,700. So you're on taking 25, you're continually eating away at the capital, and that itself has a sort of compounding effect, and hence the pot of money gets diminished. And I mean, all that tells you is that, in a very basic way, make sure you, when you do retire, that you have enough money. I mean, it's a sort of it's sort of obvious, really, isn't it? But we have dealt with clients at Wise where you see both examples. There's just a bit more than is required and your life is very straightforward. If it's just a bit less than is required, there's always a battle to try and keep the pot of money, well, keep it up with the amount that's being withdrawn. Yeah. And if you're in that situation, you're at risk of at some point having to reduce your income possibly quite significantly to make sure that you don't run out of money.
Absolutely.
So it's a subtle but important point. You know, just a bit more is happy days, and just a bit less is extremely difficult. I think Charles Dickens said something about that.
He did, and it amazes me actually the number of people I speak to that aren't aware that they can start a pension for a grandchild or a child. How is it fairly simple to do, Angus, in your experience?
Yeah, well, normally it would be their parent who would set it up, and then parent or grandparent can pay in. I mean, in a similar way, if you look at the other forms of saving for children, a junior ISA is now the sort of most popular form. Again, same process, parent sets it up, and anyone can pay in up to the limits, which is more generous, actually, 9,000 a year now. But you don't get initial tax relief. Which one's better depends what you're trying to do. With a junior ISA, the child's entitled to it when they're 18 years old, which you may or may not think is a good thing. With a pension fund, they can't touch it until they're 57, which again, you may or may not think is a good thing. So, but the pension fund couldn't be used to provide them with a deposit on their first house, for example.
No, absolutely. I quite often say that to people when I'm talking to clients, is that the most obvious, or the obvious drawback of the pension, that they can't access it until much later in life, is actually the equal and opposite on the junior ISA. Because if you save as you say, the maximum of £9,000 a year, and I appreciate not everybody can do that, but I'm sure some can. After 18 years, I think it could be worth, with some reasonable growth, sort of 180,000. That transfers on the day of their 18th birthday, and I think everybody on here could probably imagine the sort of party that they might have with that sort of cash. So
we're allowed to, yeah.
Absolutely.
My suggestion is that a sensible series of conversations about it ahead of the time is probably the right approach there, so that they don't think they've won the lottery on their 18th birthday.
Absolutely.
Just a note, the other thing that is available now is something called a lifetime ISA, which is actually can be started by someone between the age of 18 and 39, where you can save up to 4,000 a year, and you get a 25% bonus from the government, provided you use it either for a house deposit, and if you don't, then you have to leave it till the age of 60. So that's another option for younger savers. Right.
So, well, I was going to say, I think that probably covers the youngsters.
Actually, there was one more thing I wanted to say. By the way, don't be alarmed if you're listening in and you think I haven't done anything yet, or I know that my son, daughter hasn't got started and they're 30. Don't worry. It's never too late. The earlier the better, but start now is the advice I would give.
Yeah, I think that's valuable advice, Angus. So I think we've probably covered the youngsters there. Our sort of webinar today really now glosses over the next, let's say, 30 to 35 years of life, because usually that's an absolute whirlwind where careers happen, families may happen, you move house, you might move abroad, all sorts of things. So we're now sort of fast forwarding to somebody perhaps in their early to mid 50s who's approaching retirement and starting to think about what sort of income they might need and what sort of things they're going to fund. So I think this is probably back to you, Angus.
Yeah, well, I'm going to repeat, if people were listening in last week, just the same illustration. We're looking at pensions, but they're only one potential source of income in retirement. Various others depending on your situation, and when we're, as I say, we're not going to look at things in isolation. It'll be part of the whole picture. And to repeat the mantra, in terms of planning for retirement, you need to kind of figure out what it is you want to do, how much that's going to cost you, and when you're going to do it, what, when, and how much, and from there you can begin to sort of make decisions about where you're going to get your income from and how you might take your pension benefits. So again, focusing on pensions, because that's what we're talking about. You now have a plethora of options, and it can be a bit of a maze, really. But the sort of simple rules are that with a pot of money type pension rather than a guaranteed one from an old employer, or from a public sector work like NHS and so on, from an ordinary pension fund, you are allowed a tax-free lump sum at the point that you take benefits of up to 25% of the value. In most cases, there are some exceptions with older pensions, but we won't worry about those for now. Then with the remainder, there are various options, but the two options are that you turn some of the fund into an annuity, which is a guaranteed income for as long as you live, or what's now called flexi access drawdown, excuse me, which is where you leave the pot of money invested and draw off a regular income or ad hoc amounts. In either case, annuity or the regular income, that income is treated as earned income and is taxable, except you don't pay national insurance, of course. The thing about having a drawdown fund is that on the one hand, you can vary the amount of income. On the other hand, the amount of income is not guaranteed. As we saw in the earlier slide, if you don't have quite enough in the pot and you draw too much, or the investment returns don't come up to muster, then you could run out of money and be forced to cut your income. So it's not risk-free. Is that all right?
Yeah, perfect. I was just going to say that one of the sort of practical things to consider on the tax-free lump sum part is if you're somebody who has had a pension for many years and absolutely loves your job and decides you don't want to retire until many years after the state retirement age, I think I'm right in saying that some of the older schemes say that you have to draw your 25% by the time you're 75. Is that right, Angus?
That's right, yeah, because that's what the old rules used to say, and an older pension scheme, they probably haven't troubled themselves to sort of update the options on that pension fund.
But people need to watch that, don't they?
Yeah. I mean, now you can take your lump sum after the age of 75 if you want to. Various things, subtle things, change at 75. Incidentally, you can't make, well, you can make personal contributions to the pension, but you won't get any tax relief. So generally, people don't bother, and the schemes don't accept those contributions. We'll see later that the treatment of the fund when you die changes at 75. The other thing that happens at 75 is that there's a final reckoning of the fund value and the value of the benefits that you've taken or haven't taken, or the value of the fund against what's called the lifetime allowance, which is a cap on the total value. And if you exceed that cap, there's a tax charge. But again, we're not going to cover that in great detail today because we'll go off down a very long tangent. So
Absolutely. I think
sorry.
Go on. Sorry, Angus.
No, I'm on my soapbox now, so you do have to butt in to stop me.
I'll knock you off. I was going to say, as a tax advisor, the thing that we've seen over the last 18 months, 2 years, isn't as some of the tabloids suggested, that everybody's gone out and bought a Ferrari or a Lamborghini, but instead that people have started to take these flexi access drawdowns. But in their infinite wisdom, HMRC have a very strange way of taxing these, such that they assume that the amount that you withdraw will be a recurring amount every month for that tax year. So if, for example, you draw take a £30,000 drawdown in, let's say, June, HMRC will assume that you have annual income of 360,000 and tax that payment accordingly, which leads to some fairly horrendous and some quite large amounts of tax being deducted. And in my example, if you've done that in June, you probably don't want to wait until the following April or May to file your tax return and get that overpaid tax back. So there is an alternative, which is a Form P55, which we've now started to complete more and more for our clients. But it's just one for people to be aware of and to watch out for, really.
Yeah, and I know that the financial advice and account industry have suggested to the revenue that they could do this in a more pragmatic way and accept that it's a one-off lump sum. But they decided not to change their approach to this, and so they'd rather overtax you first, unfortunately, and ask and get you to claim it back rather than the other way round. But anyway, there we go. What I was going to go on to say on the sort of the bottom part of this slide is that with the way the flexible rules work, you don't any longer have to take the full amount of the tax-free cash up front if you don't want to. And if you don't need it, you might be looking at sort of paying down your mortgage or indeed buying that Lamborghini, I don't know. But if you're not, then it's quite a neat way that you can essentially each year or even each month, if the scheme allows it, take a little slice of the pension, and of each slice, 25% is tax-free and 75% is income. And that is that can be sort of quite attractive for a number of reasons. But to give you an example, if you have no other taxable income, for the sake of argument, using your personal allowance, you could draw £16,000 a year from the pension without paying any tax at all, because 4,000 of it would be tax-free as the tax-free cash 25%, and 12,000 would fall within your personal allowance. So that, you know, that could work quite well, especially if you're retiring early before your, for example, your state pension starts. So yeah, I mean, those are just a couple of ways of doing it. When you start to dig into the detail, you can slice and dice it in any number of ways. But again, if you want to sort of do something a bit more complicated, I would suggest getting some advice, of course. Indeed. So as you say, I mean, people can. They're really now it's so flexible. People can pick and choose how they want to take the income. Pulls apart from many years ago, where the default option was an annuity, and I appreciate they had much higher interest rates, but it has all changed there. So assuming that people are able to take, let's say, the amounts that they need to fund their standard of living, and obviously I think you're going to talk about how that pattern of spending might change slightly throughout retirement. But should we just now move perhaps a bit further through the retirement plan and actually even towards the position where there might be some cash left in the pot to pass on to beneficiaries? Yes. Well, should we cover the sort of very briefly basically the way that your income or your spending needs might change through retirement?
Yeah.
It won't take long, and
No,
then
absolutely.
the other bit's a bit more technical, I think, and people might need to just take a breath of air before they listen to that.
Perfect.
But here we are. So this is quite a sort of common thing that's bandied about. Whether it's accurate for every single person, I don't know. I would not pay too much attention to the numbers on the left, because your income need may be lower or higher than that 40,000. But this is sort of typically through retirement, people will tend to be more active in the early years, do more traveling, go out more, etc., and therefore want more income, sort of fairly obviously. But as one gets through to the sort of mid years of retirement, and you've sort of done your backpacking, as it were, you may actually need less income in order to support your lifestyle. But of course, as you get much older, in the modern world, you may find that your costs of living go up because of unpleasant things like care needs and so on. Of course, that may not happen. So you need to be aware that your requirements are going to change through time, and they're not fixed, which is obviously an attraction of a drawdown arrangement, is the flexibility of the income. One common way of thinking about this is to identify your basic costs of living. How much do you spend on bills, keep the car running, and keep the house in good order, that sort of thing. And then you might look at finding ways to have that income as secure as possible from your state pension, from an annuity, as it might be. And then the extra bit, your discretionary spending, if you like, you might be happier to accept some flexibility in that by having the drawdown fund. But that's just one example. And as we said earlier, I'm not saying to everybody listening that that's what you should do. Okay, so this is the sort of the last bit. What happens to this pot of money if you still have it when you sadly die? And a lot depends on your personal circumstances, but typically, if you have a surviving spouse, in most cases, they will be the ones to receive the pot of money. And they have an option of having a lump sum, just receiving the money in cash, or what's now called a beneficiaries or dependents drawdown fund. So they take over the pot of money. Still, it's still a pension fund, and they have the option to draw just as you did from the pot, or they can turn some or all of it into an annuity for themselves if that's appropriate. If you don't have a surviving spouse, the pot of money can go straight to your children. Now, do you want to just interject, Ian, with the difference between if you die before 75 compared to if you died after?
Yeah, absolutely. I mean, as people can probably see, there are a few notes on the slides here. As Angus has just said, without being too macabre, if you die before the age of 75, then actually a pension fund can be passed on to your named beneficiary, be that spouse, adult children, or indeed other. And the cash or the income payments that are then made are usually completely free of tax, income tax on the recipient. So first of all, a pension fund is outside of the estate for inheritance tax purposes, so you won't pay any inheritance tax on passing, and they can then take the benefit of that tax-free. if you're aged over 75 when you pass, then the pension passes over in the same way. It's still free of inheritance tax, usually, but on the recipient, it's then taxed at their marginal rate of tax. So if they decide to have the drawdown fund, that obviously gives them some flexibility as to when they start to draw that money, and they can balance that with their other income to try and manage tax rates. But I think it's one of the practical points you've got, isn't it, Angus? I think you might have seen some, I'm not going to say horror stories, but some fairly unfavourable tax positions come where nominations haven't been properly made.
Yeah, well, it's, again, this is all fairly early in the cycle of this, because the rules changed only in recent years. So we haven't actually seen many disasters, thankfully. But the main thing that we think is important for people to do who have a pension is to make sure that they've completed what's called an expression of wish, or a death benefit nomination. Expression of wish being the more cheerful expression, but it means the same thing. To make sure that it gets a bit complicated, but a pension is a trust, and there are pension trustees, which are the provider of the pension scheme, whoever it is, Standard Life or whatever. And in legal terms, they have the discretion to pay or give the fund to anyone they choose, but your expression of wish says, I would like it to go to, as it might be, my spouse, and or my children. Now, in the absence of a nomination or that expression of wish, they will look at your family circumstances and look for a dependent. So if there's a financial dependent and a spouse is automatically a financial dependent, they would pay it to them first in the absence of a nomination. A critical point, though, subtle but quite important, is if you have adult children, so they're not dependents of yours, they're not financially dependent, if you don't nominate them in your expression of wish, then the rules say that they're only entitled to a cash lump sum and not this beneficiaries drawdown fund. And the point there is that this could be quite a substantial amount of money. And if you're over 75 when you die, then they are going to receive that sum of money as an income payment in one go in that year, in that tax year. So if you have two children and the fund's £400,000 for the sake of argument, then they're each going to probably receive £200,000, which will be income sitting on top of their other earned income, assuming they're still working.
Certainly, there's quite a big
potentially taxable at a chunk of it taxable at 45%, which is actually more than inheritance tax.
Yeah.
As you said earlier, if they have the option of this drawdown fund, then they can just leave it, and there would be no tax charged immediately at all. And they could draw off amounts each year within their tax allowances and so on. So if you haven't reviewed your sort of death benefit nomination in the last couple of years, it's probably worth revisiting it to make sure it still suits what you want, and also your the rules as they are now. That would be my suggestion.
Absolutely, and I think the drawdown fund, I appreciate it wouldn't be for everybody, but it does just give that additional flexibility, because these things can be passed on more than once as well, can't they? So if
yes.
actually the let's say in this instance it passes to the adult children, they've been very sort of careful and prudent savers over the years. They actually don't use any or much of this inherited drawdown fund, they can then pass it on again by making their own nomination, and so the chain keeps going.
Yeah, as I say, this is the theory of how these rules would work, but because this is relatively new, we haven't seen it happening much in practice where a child now has ownership of this pension fund.
Yeah.
Now, what you do need to be careful of, actually, Ian, you sent me earlier this week a snippet about a recent court case, and this is about inheritance tax actually being applied to a pension fund, I believe.
Absolutely, because I don't think either of us have ever given the advice, don't touch a pension fund, use it as an inheritance tax saving tool, because that's not what they're designed for. But one of the very nice side effects of a pension, if you were able to comfortably live on your other income, was that, as I've mentioned, it's usually outside of your inheritance tax estate. But HMRC do seem to be starting to take a closer look at that, certainly based on the sort of headline facts of this case.
Yeah, so essentially, it was, I think it was decided in the Supreme Court eventually that if you decide not to draw income from a pension fund, sort of deliberately to keep more in the inheritance tax-free pot, they would say that you've deprived yourself of money, and in fact, it's deemed to be a transfer of value to the children for inheritance tax purposes, and that was their argument, and the Supreme Court agreed with them. So something to watch out for there, I think.
Absolutely. As I say, the case is very much fresh off of the press, but I'm sure between us we'll make sure that we're up to speed with it as more of the facts come out. But I think that largely covers what we were hoping to talk to people about pensions today. I've been a bit sneaky and had an advanced look at the questions and answers. Okay. And I'm conscious that we are quite close on time, but we'll do our best.
Yeah, we can overrun a couple of minutes, I'm sure.
Yeah, I mean, first of all, there have been a couple of people asking if the slides can be circulated. I think that's absolutely fine. I think our marketing team will get both the recording of the webinar and the slides circulated, or at least a link to the recording after this is finished. So just picking up then on some of the questions here. For the inheritance tax, this is the regular gifts out of income, I think. Can regular annual capital gains be deemed as income, enabling gifts to be made out of income for IHT purposes and thus exempt?
Are you asking me, or are you going to tackle?
I didn't know if you were going to jump in.
Well, I would defer to you as the accountant, as the tax expert.
So I think it's a case of looking at your position. It's not as simple as saying that regular capital gains do definitely qualify. I think if by taking the annual capital gains, it allows you to demonstrate that you were comfortably living and you do then have surplus income potential, that there is some potential there, but it's likely to be the problem with these is that they aren't ever challenged until sadly you're no longer here. So you're not able to ever give your reasoning or your arguments behind it. It's left to your executors of your estate to argue on your behalf. So it'd probably be easier, actually. I can see who sent that message, and I can pick that one up separately because it does really all depend on the levels of income.
Right. Oh, because it would have struck me that the answer to that would be no, but it sounds like it's a bit more complicated than that. It's sort of possibly, from what
I think it is. It is a possibly, yes.
Right.
Yeah.
Okay.
So this one's possibly more for you, Angus, a bit more planning. While looking at how much you can you afford or need to live on in retirement? How do you allow for potential care home fees later on? And this really goes to your spending pattern graph, doesn't it?
Yeah, well, that's a good question, but it's a tough one. I mean, the problem is that you don't know whether you're going to incur them at all. That's one problem. And if you do need either sort of care at home or to move into a care home, you don't know how long you're going to be there for. I mean, the average is something like 3 years, I think, but you don't know. So the cost of care homes varies quite considerably. I mean, I'm making the assumption that the local authority won't fund it for you because you have your own resources above a certain very low limit. You know, around Oxford, for example, the home local to us is about £1,300 or £1,400 a week. So it's a lot, £70,000 a year sort of thing. So you need to sort of plan for what your basic income is, your pensions that are going to be ongoing. And then, you know, you can't insure ahead of it. There used to be insurance plans that you could buy that would say we'll pay your care fees if you fall ill, but I've never seen one work, and I don't think they're really offered these days. Sorry, it's a difficult question to answer. I think you need to look at your individual circumstances, and you have to build in an expectation of a sort of guess as to how long you're going to need to pay for it and see whether you have enough resources. It's hard to be more specific than that. I mean, at the point of going into a care home or needing care, you can buy something called an immediate needs annuity, which would guarantee an income for as long as you need it. Again, you know, careful thought needed there. Sorry, that's not a very definitive answer, but I don't think it's possible to give one.
No, I think that you've covered that, Angus. There's a couple of questions then come in. So the first one was around if a grandparent is contributing to a pension fund for a minor, as in your scenario one, if the grandparent passes before the child comes of age, they've asked what would happen. I think with that, I mean, the pension fund belongs to the child, the minor, so the contributions may well stop, but the annual return presumably would continue, and it might be that the parents or another relative or something perhaps pick up the contributions, but that they don't have to. And then the child on turning to become an adult could start contributing themselves.
Absolutely, yeah. So the pension itself would be unaffected by that. I think there's a related question. What if the child dies? Well, the child...
I think because the question says prior to taking the pension, so I'm not...
Okay.
Yeah, I don't think they're dying as a child.
Right, okay, well...
That's as I read it. I'd hope I think we've probably covered that to some extent.
Well, you'd encourage them to have made a nomination, which may be to their own children if they have them, or brother or sister, or even back to their parents or something. But if there wasn't a nomination, it would come down to the pension trustees to make a decision, and it would ordinarily, in some proportion, go to next of kin, which may be their parents, or there isn't a precise answer again, but it would be a sensible one, and the family would be able to make representations as to what was appropriate.
Fine. Okay. So I think last couple of questions. This was one actually I spoke to you about, Angus, when we were planning for this. can the expression of wish be part of your will, or if not, how do you register the expression of wish?
Okay, yeah, that is a good question. It's neater to do it separately from your will. I mean, I would take legal advice perhaps on having a letter of wishes attached to your will, but nearly all pension companies will provide a standard form that you can write your wishes on and sign, and then you send it back to the pension company. So if you're a client of Wise, we'll handle that for you and talk to you about it. And then it would be registered with the pension company that's what you want. So that's the way to do it.
Perfect. And then I think the final question, which I think is probably one for you because it's about investment advice, but it's come through the chat. Do you also give advice in which funds to invest rather than just a sort of tracker fund? Or
yes, absolutely. That's one of the main things that we do. Yeah. Perfect.
I am going to dodge the other question, which is what is the best country to retire into? I think on the final slide, both mine and Angus's email addresses pop up, and do feel free to reach out to either of us. I'm just conscious that the best country to retire into, there are a million answers to that, depending on whether you want low tax rates or nice inclement or nice weather. So yeah, I think that would be a separate discussion. But thank you everyone for attending. I think Angus and I both hope you found it very useful. As I say, our email addresses are available, and we look forward to seeing or hearing from you soon.
Yeah, I know. Just to say, there's there's a couple of questions that we haven't answered. We'll come back to you directly about that, if that's okay. But thank you very much for listening. It's been enjoyable.
Brilliant. Thanks, everyone.